Good evening, everyone. Time for another Precious Metals update. My name is JR. Today is Sunday, the 8th day of March. It is 7:58 p.m. Eastern Standard Time. This is actually a video for the week ending of Friday, March 6th. I didn't have any time to do a video on Friday, so I figured I'd just knock it out right here. But this is for last week, obviously. And so before I get to the analysis today, I'll be doing gold and silver. I'm going to do platinum as well. And of course, the Dow Jones. And before I get to the analysis, I wanted to show you guys some numbers. I was doing some research here on the labor force participation rate. This is actually a government site, the United States Department of Labor, Bureau of Labor Statistics. So since 2008, that's when we started printing in October of 2008. So you can clearly see that the job participation, the labor force participation has been really on a decline. And I was wondering if this had anything to do with quantitative easing. I actually found this video phenomenal video. And this is, I guess this is a brand new channel. I don't know this gentleman's name, but at any rate, and just a phenomenal study this guy's done on the job participation, right? On the labor force participation. So I wanted everyone to see this video. I think it's a very important video. It's only 6 minutes and 15 seconds. Actually, the video is longer, but what I want to show you guys is the 6 minutes. If you want to, I'll have the link below. If you want to go and subscribe to his channel as well. I don't know how good his channel is going to be. This is his first video, but this is just an amazing study, and I wanted to make sure that everybody got a chance to see this. Of course, I'm subscribed to it, or I'm subscribed to this video, to this channel. So anything important, I don't know if I'm gonna agree with everything this guy's going to say, but as far as this first video, just a phenomenal study, and I wanted to pass it along to you guys. If you're not interested in this, which I think you should watch it, you can just skip to about 6 minutes and 15 seconds, and you get to my technical analysis for all the metals, for gold, silver, platinum, and the Dow Jones as well. So without further ado, I'll start the video again, 6 minutes and 15 seconds long, and after that we'll get to the video analysis. Okay, hope you like this amazing studies this guy's done.
Welcome to the very first episode of Best Evidence. My name is John Titus. In a few minutes, I'll talk about this channel and where it's headed. But first, I want to show you a short animated film that I just made. It takes the most recent batch of U.S. job data and puts it into historical perspective, which is something that the media never seems to do. I think after you see this film, you'll have a better understanding of why that is the case. According to mainstream economists, the downturn of 2008 ended quickly with a recovery that started in June of 2009. This recovery buzzword, however, which the media has pushed relentlessly for over 5 years, fails to describe what's happened to U.S. jobs. The labor force participation rate, for example, has not only dropped since 2008, but has done so for 6 straight years, smashing all records. Unlike many other economic indicators, the participation rate is easy to grasp and hard to manipulate. It's a simple percentage of working-age people who are working or looking for work. It's a far more accurate measure of joblessness than the unemployment rate, which ignores the vast majority of people in their working-age years who aren't working. Over the last 60 years, the U.S. labor force has undergone 3 distinct phases. The third and current phase is horrifying. As we shall see, the meltdown of 2008 never ended because the powers behind the bailouts that characterize this era have been actively destroying jobs all along. After sputtering around in the 1950s, the labor force participation rate stabilized in December of 1962, albeit at an all-time low for that decade. The labor force included 71 million people back then, out of a working-age population that totaled 121 million, so the participation rate was 58.4%. The rate then increased for an astounding 37 years, topping out at 67.3% in February of 2000. This ended the first and by far the longest and best era for American workers. spurred on by a manufacturing boom that drew women into workplaces by the tens of millions. The labor force more than doubled in size, adding 72 million people out of a working-age population that grew by just 90 million. In other words, for every 100 people added to the working-age population, 80 entered the labor force. These 4 decades were, without question, the golden age of the American middle class. In 2000, though, the fruits of so-called free trade showed up in the participation rate. As American factories were shuttered and U.S. jobs outsourced, labor force participation started to drop, at first slowly. The 12.5 million people added to the labor force accounted for little more than half the growth in working-age population. This second phase ended when the full force of the financial crisis hit in October of 2008. This began the third phase, which has sent labor force participation over a cliff. Only 2.3 million people have entered the labor force out of a working-age population that's grown by 15 million. In short, job creation in America is screeching to a halt. This disaster has been caused by bailouts. During the manufacturing boom, the labor force entry rate, which for any given period is that percentage of people added to the working-age population who enter the labor force, was about 80%, as we saw. In the era of so-called free trade, that number dropped to 54%. Today, the labor force entry rate is completely unsustainable at 15%. Out of 100 people who come of working age now, in other words, 85 aren't finding work and aren't looking for work. What's behind this catastrophe is immediately apparent from the U.S. monetary base. Before the meltdown, the monetary base was only a hairline bigger than the total amount of cash in circulation. They both grew at roughly the same rate as the general population. They diverged radically, though, when the bailout started in October of 2008, which is exactly when jobs started vanishing by the millions. While cash in circulation has maintained its slow pace, the U.S. monetary base has exploded, quadrupling from $1 trillion to $4 trillion. This is the doing of the Federal Reserve, which in 6 short years has printed 3 times as much money as there is total cash in circulation. The Fed has siphoned this new money to a handful of megabanks that were all flat broke in 2008. The result is a crony economy where innovators and small business, the real engine of economic growth, are unable to take the risks of expansion or new ventures. By shielding the precious few from their own failures, the Federal Reserve has guaranteed the failure of everyone else. The colossal destruction of jobs caused by crony money printing is clear simply by turning the labor force participation curve upside down. The inverse correlation at work here is tighter than a glove. For each box of printed money that's put into failed hands, the jobs market dries up a little more. These two charts might as well be identical. This isn't some cosmic accident. It's happening because the Federal Reserve exists for the sole purpose of enriching big banks, and they all went broke a long time ago. The Fed does whatever it takes to keep a yacht full of failed executives and their friends unimaginably rich. If this requires an economy of 300 million people to be blowtorched, then a blowtorching is what that economy will get. This is exactly what has occurred over the last 6 years. The Federal Reserve's only real job is to sell this mass murder to its victims. It does this by pumping legions of meat puppets in the media and elsewhere full of propaganda. How much longer the real economy can survive, though, when 85 people with no hope of finding work are being pumped out for every 15 job holders, is a different question, one that the Federal Reserve doesn't give a damn about.
Wow, what a great video. I mean, this guy really puts things in perspective. I actually went on this site. I was doing some research here on YouTube, and that's how I came up. That's how I came across that video. But you can clearly see this guy has some very, very accurate numbers. We can go here. This is from 2005. You can see that 2005 all the way to 2009. To the end of 2009, roughly October of 2009, that's when the bailout started, and that's when everything started to decline. And you can go as far back as 1948. And if you go back all the way to 1948, you see that this guy, I mean, you know, this guy has some serious data here. So this is not made up. This is not fluff. This is real numbers. You see, this thing took off back in 1966, right? We took off in 1966, and we had a flat line, and here we go. Now we're going down, and we're going down pretty hard. As scary as this is really exciting for me because obviously we're in the precious metals market, and this just means that when it hits the fan, we know that the market is going to go up. Now you see already starting hitting the fan in euro terms, right? So look what happened to gold. Gold, look at that candle, just a phenomenal candle. What a candle! And I would expect to find some resistance, some support here in euro terms. This is the monthly chart. So even if we do fall back, let's say to the $1,000 mark from 1079, we can still see that gold is taking off here pretty hard when it comes in euro terms. And if we see this in Japanese yen, gold and Japanese yen terms, we'll see also that this thing has taken off as well. So really, gold, gold is always going to prosper against fiat currencies. It's just a mathematical guarantee. Gold is tangible and it's something versus fiat money, which is just guaranteed debt. But at any rate, let's get back to the good stuff, right? Let's get back to the technicals. A lot of great things here happening in the precious metals market. Let's see here, gold. Right now, this is the monthly chart here for gold. Now, I've said this before. You have a bullish engulfing candle. You want to get in halfway, right there at 1223. That should have been in some entry. Okay. Of course, you want to put a stop loss roughly around, let's say, on a chart like this, you put a stop loss at around, let's say, 1100 or maybe 1110 or something like that. And you want to target higher prices. You want to target a bigger you want to target up here, anywhere between 1328 all the way up to 1400. That's on the monthly chart. Stochastics are in the process of changing their minds. That we're heading up, but now they look like they might head back down. So who knows? Maybe this zone will not work. Maybe the market will continue to go down. Who knows how much they can push this market down? But again, this is the zone here, and you just want to keep an eye on this right now, especially on the monthly chart, right? The weekly chart right now, really at the bottom of my zone. I love buying at the bottom of my zones because basically you can buy in, let's say here, which I bought here at 1167. Actually, you're on 1167. Yeah, that's where I got in. This was the bottom of the zone. Big, nasty candle here. But again, we have to take all the trades. If they're in buying range, we have to take them, especially a trade like this that's all the way at the bottom of the zone. If we get stopped out, hey, that's the way it works. But this is a phenomenal trading opportunity because this is one of those trading opportunities that will, literally you can probably make 3 to 4 to 5 to 1 possibly, right? And that's what we're shooting for. We're shooting for this market to come back over here. So let's say you have a risk right here. Let's say we're to stop at 56, 57, 58. So you're risking around $13 from 1170. This thing can easily go back up to 1200. And if this market isn't a bull market, if this bull market has begun, then you can even, this thing can technically come up to 1300. Now, if you have the how do I put it? If you dare allow this market to just do what it's going to do, who knows? Maybe you can bring this thing up to 1270, which is, again, you're risking about $13-14 to make over $100, possibly even $200-300, right? So you can go really big. These are the huge money makers right here. I love buying at the bottom of my zones. Okay. Right, stochastics are on the downside, still pointing south, so this thing has further room to fall. But again, this is a trade. Like I said, I'm taking this all day long. If I get stopped out, hey, you know what? That's how you trade. You have to take them all, because if you start picking and choosing which ones you're gonna take, you'll never get the winners, and the winners will make you 2 to 3 to 4 to 1. And the losers will lose 1%. 1 or 2, whatever percentage you're risking on your account. So again, phenomenal trading right there. I took it. I'm in, and let's see what happens. Okay. But you can trade it a few different ways. You can trade it on the monthly chart, or you can trade it on the weekly chart. Right? That's up to you to decide. The daily chart here broke through this key support line here. Right, broke through this key support, and you saw this market just tank. This was after the job reports on Friday. Nothing too exciting, nothing too exciting, nothing too crazy. But again, we had that big sell-off on the gold market, but really across the board because everything sold off, right? So the daily chart, so market still pointing south. So again, still further room to fall. As of now, the daily chart is definitely negative, is definitely bearish, right? We can easily see here that we are just easily creating lower highs, right? Right? And of course, lower lows, right? Lows. So this is the exact definition of a bear market. But again, on the weekly chart is bullish, if you ask me. The reason why I say that is because we took out we actually took out three. We took out this level of resistance, and this final level of resistance, and took it out. So again, this is a great trading opportunity, I feel. Again, a lot of buyers, enough buyers to take off three levels. Excuse me. Enough buyers to take out three levels of resistance. Okay, big fall to the downside. Time to rebuy again. That's on the weekly, but the daily chart is still bearish. Okay, so you can take this up if you want to be a little bit more conservative. You can bring this up to at least 1190. Again, you're still risking one to make two, right? That's your gold chart. Let's look at silver. Silver also in a similar pattern. Now, I like silver a bit more than I like gold. And the reason why is because I see this wedge, right? Well, before I erase all this, let's start with the monthly chart. The monthly chart right now, again, doing something very similar. So this is the level, right? This is the level of support, okay? Came all the way down here, tested the 1850 range all the way to the top of the zone, which again, when this market was falling, I said that we might find some support at the bottom and possibly go to the top of the zone. It usually does that. So let's just say for gold, I would say that worst case scenario on this chart, on a weekly chart like this, you're going to see a level, you're going to see something like this, where this market is going to go from here to the top of the chart. So you can easily see that from the bottom of this zone here, we can easily come up and test this 1190 zone. That should be your first target. Your second target, maybe roughly in this area here, maybe around here, maybe 1220, okay? And then your third target will be up here, right? But that's the way you should play that. So let's go back to gold here. To silver. And there's your zone, right? The monthly zone still bearish, right? You're still creating lower lows and lower highs, right? Monthly chart is bearish. Weekly chart is bullish, right? You took out one level here, another level here, two levels. So that's bullish for me, okay? This is your zone here for silver. At this point, for silver, unlike gold, silver still has not created a new low. This is your low here. This is your second low. And this low is so close to this one that I'm going to call this the same, but until it surpasses this level here, this is still, you can kind of argue between bearish and bullish, but I'm going to call this fairly neutral. But in the same respects, you have the moves that we want to see. We have a move going above the 20-day moving average, coming back down. Currently, we are at the 20-day moving average. We're actually at the bottom, so we are actually at the lower end, the 20 average of closes. That's at 1589. Current price is 1586. Right? Stochastics are still pointing south, so still further room to fall. We'll see how that plays out. But ultimately, what we want to see is move from here, come back, testing this 20-day moving average, and create a higher high. So that's my trade for silver. I'm holding this until this thing goes either up or I get stopped out either at a break even. If we move up to around this level here, maybe the high 16s, I'll put it back at break even, or maybe above $17. I'll decide when, but I'll maybe put it in at break even if it gets around this level. If I get stopped out, it is what it is, right? I can tell you one thing: no matter what, if this market comes back down to the 14 range or the $13 range, if it creates another low, I'm buying. Again, the fundamentals haven't changed. The Federal Reserve, they're going to continue to print. They're going to continue to ease, and especially with the strong dollar, that's exactly the opposite. That's proof of failed policy, right? Because what they're looking for is a weak dollar, and what they're getting is a super duper strong dollar, right? So that's on the weekly chart. Let's look at the daily chart now. So the daily chart, let me erase some of this. I want to show this real quick, right? So this is the daily chart. Right now, what we're seeing is a wedge. We're seeing, this is what we're looking at, right? This is a descending wedge, right? Let's look at, I think I've shown this before, these descending wedges. And this is how they usually play out, right? I've shown this before. This is a descending wedge, right? Anytime you have prices declining in this sort of a triangle, that's called a descending wedge, is usually very bullish. So there's a lot of things that I like about this silver market here, okay? I mean, if this market falls below 1550, again, I can't say that I'll be too surprised because this market really has been manipulated for quite some time. And I can't say that I've ever thought that this market would fall below $18. It is what it is, but in the same respects, this is really a gift from the market, if you ask me. And I think silver is going to offer possibly one of the best opportunities of the decade. I really feel that silver, definitely by the end of 2020, by the time we get to 2020, I see silver all the way back up here at these levels, if not here, much, much, much higher. All right. So there's your weekly chart. Again, stochastics are still pointing down, but technically silver looks a little bit nicer. We went above the 20-day moving average, right? Above the 20-day moving average, coming back down, testing the 20-day moving average. Now we want to see higher prices. Again, very small risk to reward. You're risking about 45 cents from here. If you put a stop loss at around 15.30, or you can put a stop loss below this level, below this Bollinger Band around 15.07. Or if you want to go long term, you just put a stop loss at around $14, right? You're assuming that this is not going to create another low. But if we get stopped out here, I will probably just pick some long-term trades, not big trades, but some long-term trades, maybe around the 14 level, just so for longer term. And then my final price, I've said it before and I'll say it again, between 12.5 all the way to 13.5. That's probably when I'm going to make my last purchase of silver. At that point, we're going to set it and forget it, right? This is the daily chart. And again, as I was saying here, we have that wedge. That wedge looks really nice. So again, beautiful wedge here. I really like it. That wedge coincides with this level here, with this zone, okay? Again, I got inside the zone at around 1580. Right now we're at 1587. If it falls down further around 1550, again, I love buying at the bottom of my zones with a short stop. But again, I don't know that I will. I think I'm just going to let this thing roll and see if this thing runs its course. When this market goes above this level here, when it breaks this trend line, then I think we'll have confirmation, and I think we can buy on dips at that time, right? So that's your daily chart here for silver. So there's both gold and silver. Now let's look at the Dow Jones. So the Dow Jones right now taking a beat down on Friday, just like gold did, right? We can clearly see here that the monthly chart is really running out of steam. This is going to be a phenomenal, just a phenomenal dip when this thing finally does fall. You have absolutely no volume here, okay? Very liquid market, and this is just a huge rally to the upside with absolutely no volume to back it up. Your stochastics are squeezing as well. This just doesn't look good. This thing doesn't look good. When this thing falls, this thing is going to fall really, really, really hard. That's the monthly chart here for the Dow Jones. big bullish engulfing candle here. We did go above this level, right? Let's look at the weekly chart. Our all-time high was at 18,100. On my last video, I said here that I was really surprised that we went above and we didn't keep going. I did suggest that was a sign of weakness. And as of right now, we're testing this 20-day moving average band of highs and lows. We'll see how this thing holds out, but this looks like a failed breakout. Here's the breakout right here. If you saw my last video, I called it. I said that, again, once you break all-time highs, you want to see a lot of strength, especially when you've been trading sideways for 3 months, right? We've been trading sideways since mid-December. Actually, probably over here since the beginning of December. Traded sideways for almost 3 months, and once we broke above, on price action like this, we should have seen. This is what we should have seen. We should have seen a move like this easily, and we didn't. And again, I called it roughly around here. I was really surprised. We did see another candle, but this looks like a false breakout. And again, I called this back here. All right. I don't know if you guys remember, but I called this right here. You see this? I called it. The market came up. Again, trading sideways for quite some time, and you should have seen a bigger breakout. This is what happens when you have a false breakout. You have a quick and fast move in the opposite direction. I am expecting just that. I think I'll sell the Dow on any opportunity that I get, but this looks like a false breakdown, and I will be very, very, very surprised if this thing doesn't happen. The same price action doesn't happen here, where this market comes down at least to this area here to test this long-term trend line. That's on the daily chart, right? The chart we're going to look at is platinum. Let's look at platinum. Why do I like platinum so much? I mean, platinum has really been trading with oil, okay? Platinum has been trading alongside with oil, and platinum is also making a wedge, a descending wedge, right? You can do the wedge from here, or you can do the wedge from up here. Regardless, it's a wedge. So I would expect prices to go from here. This will be your level of support here. This is another level of support. Okay, I'm hoping that we don't fall that far down, but this is what we're looking at. If we continue to fall down further, okay. And that's where it is. I mean, right now platinum is looking that's a wedge on the monthly chart. On the weekly, I mean, you're looking at the exact same thing, just a wedge, and really trading alongside with oil. You have, I think that if this thing falls below 1150, this can easily fall to the 1100 range, possibly below the 1100 range. But again, we'll see how this thing plays out. I like this area here to buy, but again, I'm already vested in gold and silver, so I'm not making any more bets on platinum. But on long-term scenario, platinum usually trades higher than gold. So just on ratios, you should be fine if you were to take a trade like this. Okay, that's my opinion. So again, guys, that's about it. I hope you enjoyed the video, and have yourself a great week. Good luck. Bye-bye.